Good morning, everyone, and welcome to our third North Sea Upstream webinar. This one follows the Norway one we did in December last year and a UK-focused one we did in February earlier this year. My name is Ross Cassidy, and I'm the manager of the North Sea Upstream team here at Wood Mackenzie, and I'm joined this morning with three colleagues, Nivan, Erin and Vari. Today, we're covering the whole North Sea region, and we are going to present three topics that we've recently done some new analysis on. So up first, we have Erin Muffett, who's going to give you an update on North Sea investment and cost trends. This is part of a global series of insights that we're doing at Wood Mackenzie at the moment, and they'll be published in the next couple of weeks. Then after Erin, Nivan is going to give some thoughts on the changing corporate landscape in the North Sea. We've seen some really interesting deals this year, and finally private equity have really stepped up and taking a significant role in the region. So we'll get some thoughts from Nivan on that. And then Vari is going to finish with some thoughts on decommissioning. This is the latest in a series of decommissioning insights that we've done over the past 3 years, and this one looks at North Sea decommissioning from a corporate view. So that's what we've got coming up today. Before we begin, let me explain a few things about how this webinar will run. First of all, it will last about 30 minutes, give or take. Attendees can't speak, but you can post questions in the Q&A panel. We'll answer these live if possible. We'll take a few questions at the end if we have the time. And any ones that we don't get round to, we'll answer them in the slide pack. If you have any technical issues, you can use the moderator chat panel to seek assistance. And finally, we are recording this, so you will be able to access it and the slides and any of the Q&A that we don't get round to on the WoodMac portal later today. Okay, so with that out of the way, we're good to get going on the presentations. So I'll now hand over to Erin to talk about investment trends and costs in the North Sea.
Thank you, Ross. So, hi, I'm Erin Muffett. Hi, I'm Erin Muffett, and in this section I'm going to give you a sneak preview of a new report which we're due to publish in the next few weeks. The report is called Europe, Investment and Cost Trends, and in it we take a look at the reductions which have been achieved for CapEx and OpEx, and our view on how these might move in the future. We also review the investment and production outlook and do a deeper dive into some cost reduction case studies on specific assets. So first of all, let's look at the CapEx outlook for Europe. In the left-hand chart here, we show our current view of capital expenditure. Sanctioned spend is in the grey, and spend associated with pre-sanctioned projects in the green. For context, we've put on our overall investment profile from back in 2014, and also our view from last year in the navy blue. So overall, the outlook is pretty similar to last year, but there are some slight differences. And most of this has been driven by changes in the pre-FID portfolio. There are projects which have taken FID and are now under development, but companies have also been working hard on existing projects as well as progressing new developments. So let's take a closer look at the pre-FID portfolio. We look at the chart on the right-hand side. This shows investment associated with these developments. We've split the chart into CapEx associated with those projects which were classed as commercial last year in Navy, and those projects which have been added to the pre-FID pipeline in grey. And those projects have been added within the last year. Around 20 greenfield projects, totaling around $11 billion, have been added to the pre-FID portfolio in Europe. And confidence is up, with companies keen to sanction many of these projects in the near term. Now, although these projects are new to the pipeline, they're not strictly speaking new. Many of the developments have been actively worked on during the downturn and optimised to realise economics which are much more in line with a lower for longer oil price. In addition, many of these projects are subsea developments, with companies looking to sanction lower risk developments and take advantage of lower costs. So now let's take a look at operating costs. And here we're focusing specifically on the North Sea. If we look at the chart on the left-hand side, first of all, we've got annual operating costs in the navy bar chart, OPEX per barrel on the light blue line. Overall, operating costs have been slashed, dropping from around $14 a barrel at peak in 2014 down to $9 a barrel this year. Companies have been able to take advantage of market deflation, but the biggest impact we think has come from improved efficiencies, and that includes scaling back and deferral of work. If we look at the chart on the right-hand side, and here we've compared OPEX per barrel for the individual countries, 2014 versus 2017. And they've been fairly hefty cuts to the UK, Norway, Denmark, and also the Netherlands, with costs coming down across the board. But for some countries, production has also played an important part. And this really has had the biggest impact in the UK. Here, OPEX per barrel has dropped from around $29 a barrel in 2014 down to $14 a barrel in 2017, primarily due to a reduction in cost, but also partly driven by an increase in production. Production has increased by around 30% over this time frame due to better production efficiency and the start-up of new fields sanctioned pre-downturn. So, for the final slide in this section, I'm going to take a look at one of the 5 case studies which we included in the report. Here we're looking at the Greater Catcher Area. This is a premier oil-operated project. It's located in the central North Sea in the UK. Now, the project was sanctioned back in 2014, and costs were really at their peak. If we look at the CapEx estimate at FID, it was around $2.25 billion. CapEx per barrel standing at $22. So let's compare that with our current view. Development CapEx has been cut by $500 million, shaving nearly 25% of the original cost estimate, bringing CapEx down to $1.75 billion, CapEx per BOE dropping to 16. So if costs were locked in at the point of sanction, how has the operator managed to cut costs? Well, there are a few different factors at play. We have split up the cost reductions into 4 buckets, shown on the chart on the right here. Market effect, project optimization, project execution, and FX impact. Starting off with market deflation, this was pretty limited. As we mentioned, sanctioned in 2014, major contracts locked in at this point. However, some costs have been reduced through later contracting, renegotiation, and some reductions in owner costs. One of the biggest impacts, FX. Majority of CapEx spent in local currency and spent during a period when the dollar was performing strongly against the pound. But the operator also optimised the project, reducing the number of wells down from 22 to 20, which reduced drilling costs and subsea costs by over $100 million. But perhaps the most interesting part of this story is the project execution part. It's accounted for nearly a quarter of the reduction in costs. The main drivers behind this have been improved drilling efficiency. Wells drilled to date have been under budget and ahead of schedule. Subsea installation has been quicker, enabling large reductions in allowance and contingency. And there's also been leaner management. So I think what this case study demonstrates is that even projects sanctioned at peak cost in the UK can make savings. This is not a supply chain deflation story. Rather, it's partnering with service companies to ensure first-class execution. And what's also notable about this project is that the reserves have also increased by over 10%. So that was a very brief introduction to our new report. This will be published on the portal in the next few weeks, so I'd encourage you to watch out for that if that's piqued your interest. And now I'm going to hand over to Nivan, who's going to talk about the changing corporate landscape in the North Sea.
Thank you very much, Erin. So today I'm going to talk about the corporate landscape in the North Sea. Over the last few years, we've seen a clear shift from large companies, such as the majors, to a wave of smaller, more North Sea focused players. We're going to look at what these new companies are looking to do, and ultimately, who do we think is best placed to create value? So kicking off with M&A, 2017 has been a bumper year. We've seen $12 billion of value traded across the UK and Norway so far. Now the chart on the left looks at activity by peer group. And when we look at who the buyers and sellers have been, well, it really reinforces that point about a changing of the guard. So for the majors, they've been pretty much in selling mode, of course with the exception of Total's opportunistic acquisition of Maersk. So they've been looking to move down the cost curve and meet quite lofty divestment targets. And if they don't believe the North Sea holds the scale of opportunity that it once did, well, it clearly becomes a divestment candidate. For the utilities, they've been looking to get out of E&P altogether. And so, who has entered into this space vacated by these larger integrated energy companies? Well, it's been some of the independents, such as EnQuest and INEOS, continuing to try and grow their positions. But perhaps most intriguingly, it's been the wave of private equity money that's finally made its way to the shelf. Now, PE has long been touted as a buyer in the North Sea, but it wasn't really until the end of last year with those Siccar Point deals that we thought, okay, it's finally happening now. And since then, it's just caught fire. Currently, there's more than 20 PE-backed companies active in the North Sea. And we've plotted these companies by their level of funding, but also their different strategies. Now, typically, private equity has looked to go down the exploration route in the North Sea. So explore, discover, and monetize before you get into that costly and high-risk development period. But that's all changed. We're now seeing companies become developers, get into producing assets, and in some cases, even take over operatorships. Now, these are deals that would have been unthinkable a couple of years ago. And I think what's most interesting is perhaps that operated strategy, because we've seen success here in the past, whether it's EnQuest at Greater Kittiwake area, Apache at Beryl, or in this case, Aker BP, or as they were at the time, De Norske, at Alfheim. So since taking over operatorship from Marathon back in 2014, they've reduced costs, they've invested, and they've generated value. OPEX per BOE has been cut by 50%, a combination of the depreciation of the kroner against the dollar, increased uptime at the FPSO, but perhaps most interestingly is increasing production. So they've actually invested in the downturn and drilled double the number of wells than what was planned under Marathon. Now, this is not to say that Marathon wouldn't have invested, but there's no doubt that if you're a smaller, more North Sea focused company, it's much easier to attract capital in the North Sea than what it is for a larger international player. And has this investment worked? Well, yes, it has. We've compared our 2014 and 2017 models under our current price deck, and you can see nearly a 40% increase in value. And this is something that Aker BP will look to replicate at the assets it purchased from BP Norway last year. And the market clearly believes in this story. Since its formation in 2016, we've seen a doubling of their share price. So it's no surprise then that we see the likes of Chrysaor, Point Resources, and Neptune look to replicate this model. They've taken over operatorships from these large integrated energy companies and will look to invest where these companies haven't been able to do so. But can they be successful? I would argue that Aker BP is pretty unique in the sense that they have already an established alliance with the service sector, but they also have a compelling growth story. They have Johan Sverdrup, and they're exploring in frontier areas such as the Barents. Arguably, these companies don't yet have that growth story, and so it's going to be challenging to monetize their investments in 5 years from now. So ultimately, they have to continue to grow and buy assets. But how easy will that be? Currently, there's an unprecedented amount of buyers that we think will look for assets in the North Sea. We have the North Sea focused independents. We have the PE companies. We think there's some large caps that will look to target growth again, particularly in Norway. NOCs with various mandates and production targets, and a whole bunch of wildcards. So emerging is a huge amount of buyers. Is there enough to go round? Well, this is our internal deal pipeline. So it's everything that we think or know is up for sale in the North Sea. We've plotted these packages by their value on the left-hand side and the 2018 production on the right-hand side. And there's a couple of fundamental points here. Firstly, it's still a relatively full pipeline, but there's certainly not the obvious deals that we saw at the beginning of the year. And if you want to buy production, it could be tricky. If we take those 40 or so buyers that I showed in the previous slide and assume that they want to buy 15,000 barrels of production, is there enough to go round? Well, clearly not. And for this reason, we think that buying producing assets, well, we think the M&A market will tighten for those in the next year or so. So arguably, if you want to grow, it's better to go down the development route because there's plenty to go round. And I think this chart shows this pretty well. This is all the projects that we expect to get the green light over the next 5 years. We've plotted these projects by their break-even price on the y-axis, our expectation of FID on the x-axis, and the bubble size you see is the reserves. Firstly, it's a very full pipeline. And what that means is there's a lot of companies will be looking to farm down capex. Secondly, when we showed this chart a couple of years ago, the bubbles were much higher up. As Erin has pointed out, costs have come down significantly. And if you believe in the improvements in project execution, then I think being a developer is not a bad place to be. But I think regardless, it's going to be fascinating to see what happens in the North Sea over the next few years and see who's going to be the winners and who is going to be the losers. I'm now going to pass you over to Vary.
Great stuff. Thanks, Nivan. Excuse me. Hi, everyone. I'm Vary, and I'm going to talk to you today about decommissioning. I've got a few slides to take you through from a report that we recently published called North Sea Decommissioning: A Corporate View. And as Ross said, we've put together a series of studies on decommissioning already. There's lots of interesting ways to look at decommissioning, and you've probably seen material from us already talking about decommissioning activity, the cost of decommissioning or the fiscal treatment of it. So today we're looking at it from the corporate angle. And a few fast facts to get us going and to set the scene. So in the North Sea region, which for this we're talking about UK, Norway, Netherlands and Denmark, there are just over 1,000 fields producing oil and gas today. We expect 247 of those fields to cease in the next 5 years, so that's almost a quarter of existing fields. And at the same time, we're modelling 90 fields to start up in this period. For companies, there are 113 companies that are involved in producing those on-stream fields. And we expect 78 of these companies to incur some sort of decommissioning spend in the next 5 years. So that's 70% of the region's companies. We expect the total spend on decom over the next 5 years to reach $20 billion in the North Sea. Now, to put that one in a bit of context, the spend in the previous 5 years was about 10 billion, so half. You can really see the ramp up in the next 5 years ahead. And for a bit of global perspective, that $20 billion here in the North Sea will represent about 2/3 of global decommissioning spend. So you can see the North Sea's got a very important part to play in this sort of emerging new part of the industry. We ran the data on all 78 companies involved for the study, but today we're really going to focus on the top 20 in terms of spend, top 20 companies. And for those top 20 companies, we had a look at how North Sea decommissioning spend shapes up against the rest of the spend in their portfolio. In the full pack that's available on the portal, there's a slide with a bit more detail on this, but the headline here is that as a group, those top 20 companies will spend 8% of all their global capex in the next 5 years on decommissioning North Sea assets. And lastly, a quick regional check-in. We expect 65% of the next 5 years decommissioning spend to be spent in the UK sector. So on to the companies. Which companies are on the hook for the most decommissioning in the next 5 years? Well, here we've got the top 20 companies in terms of North Sea decommissioning spend in the period 2018 to 2022, and the colour split on the chart that you can see is by country of spend. So Shell, ExxonMobil and Total, when we include Maersk, have the most to do. They'll spend roughly $2 billion each on decommissioning in this period. And just to be clear, this is Shell post the Chrysaor deal. And for interest, we had a look at how Total and Maersk Oil stack up separately. So on their own, they would have come in at 5th and 6th on the list individually. And actually, they've got very similar decommissioning liabilities over this period at about $900 million each. Is it a surprise to see 3 majors up there? Well, not really. These are the old giants of the North Sea, the ones that built the biggest platforms and developed the biggest fields. At the same time, though, there is quite a big gap between the 3 majors at the top, Shell, ExxonMobil and Total, and the rest. BP and Statoil, for example, are much further down. And that's because BP has been busy honing its North Sea portfolio over the past 5 to 7 years, focusing on longer-term growth and divesting mature assets. And Statoil, of course, has got a very long reserves life in the region. Eni and Chevron with much smaller North Sea portfolios. So if we check back to the top 3 again, for Shell and Exxon, it's mostly a Brent story. Even with derogation, we estimate that Brent is a $2.5 billion decommissioning project, lasting 18 years in all from start to finish. And for Shell, the additional Danish spend you see in there is driven from its involvement in the Tira area. For Total, one of the main drivers is mid-life decommissioning at Ekofisk, and that's the same for ConocoPhillips next door to it in the chart. And for Total in the UK, actually its decom spend is mostly driven by the newly acquired Maersk portfolio. I didn't include the number of assets starting decommissioning in this period at the risk of complicating the chart, but I do think it's an interesting angle, because the top spenders actually have relatively few concurrent projects in the next 5 years, where a company like Perenco, for example, we see as having many more projects, but projects with inherently lower costs. We're comparing here very many small, unmanned, lightweight platforms in shallow water with a few simple wells versus huge concrete platforms the size of the Eiffel Tower with hundreds of wells. And actually, I think that comes out quite nicely in the next slide. So in this slide, what we've got the same top 20 companies in the same order, but this time the colour split is by the type of decommissioning spend. And you can see that across all the spend in this chart, we expect well P&A to represent 50% of spend. Some companies look particularly weighted towards well P&A spend with sort of large chunks of red in their bars. In general, this is where companies are looking at decommissioning assets based on subsea wells. So Premier, Repsol and CNR are all good examples of this, as FPSO-based assets are coming into the decommissioning zone from 2018 onwards. In contrast, we've got companies that look heavily weighted towards facilities decommissioning. So when we talk facilities decommissioning, we're talking about platform removal, that's in grey, and then the costs of running the facilities and making them hydrocarbon free until they are finally removed, and that's what we're calling post-COP OPEX in the green colour. The companies that are most weighted towards facilities are those that have got the large and long-term decommissioning projects, so Shell and Exxon at Brent that we've already talked about, and also Hess and Aker BP at the Valhall redevelopment. And finally, I think it's pretty interesting just to have a look at the overall figures that we're talking about here. $10 billion in well abandonment. That's compared to development drilling in the period that we're modelling of just over 40 billion. So a quarter of drilling spend being on abandoning wells, 4.5 billion on removing platforms, and actually quite a significant level of spend on pipeline abandonment. And I think that's partly driven by the large number of southern North Sea assets that we're looking at coming into the decommissioning zone in this period, and quite a complicated network of pipelines being involved there. Of course, there's a wide variety of capabilities and strategies for navigating North Sea decommissioning. And for all companies, including governments, of course, cost reductions must be top of the list. Some operators are leading the way on technology investment and advancement, but for others it'll be about working collaboratively with other operators to share the load of decommissioning. For many companies too, there's a fine balancing act between development spend and decommissioning spend. So unfortunately, there's not time today to take you through the 4 case studies that we had a look at in this insight, but the full report that's available on the WoodMac portal looks at 4 companies to show how we think that they might navigate the upcoming decommissioning spend that they're looking at. And we've looked at Shell, at Premier Oil, at Perenco and at Decom Energy that have all got individually quite interesting ways to look at decommissioning. So please do look that out on the portal. It's published now, and get in touch, as we'd be happy to take any questions that you think we can help with.
Thanks, Barry. So we've got a few minutes to do some questions. All right, so I've selected a few here. So let's just go back to Erin, firstly, on the investment and cost trends part of the presentation. So, yeah, very interesting case study on Catcher. What other case studies are included in your insight? And can you share any interesting pointers before it's published?
Sure. Well, in the report we looked at a variety of projects. So we looked at a couple of Norwegian projects, including the Birding Field and Johan Sverdrup Phase 2. We also looked at Alfheim, which is an OPEX example, and Anna and Doina in Romania. And I think some of the interesting things that we saw, for example, if we take Birding, Statoil was able to sanction this project back in August 2016 with an impressive 70% cost reduction, and that was with a slimmed down development concept. And this kind of typifies a bit of a trend that we've seen in terms of projects being optimised and taken forward with a slimmed down approach. Johan Sverdrup Phase 2 is another interesting one. This was really around Statoil undertaking project optimisation and ultimately opting for a subsea development over the original wellhead platform concept. And that's really a story around going back to the drawing board with the development concept and supply chain reductions being pretty limited post-2016. Yeah, and if you're interested in the others, then certainly watch out for that when it goes up in the portal in the coming weeks.
Great. Thanks, Erin. It's a question on decommissioning, Barry. Obviously, a large amount of decommissioning liabilities over the next 5 years. What are companies doing to reduce these?
To reduce the cost?
Yeah.
So it's a good question. There are probably a few different things at play. The first thing to say is that we've probably over the past 5 years we've seen our decommissioning estimates just increase steadily, and we think we're probably at the stage now where we're starting to see them plateau off and look at going downwards instead of upwards. A few things at play. So there's obviously the near term just cost deflation that Erin talked about. The same rigs and vessels that develop fields abandon fields, so that's affecting near term decommissioning. Then we've got things like folks really focusing on technology, so looking at ways to abandon wells without rigs, for example, and looking at things like that. And then the third thing that I sort of mentioned a little bit but didn't go into in the talk was about operators just approaching the way that they look at these programs differently. So it's collaborative working and batch programs to see how they can just manage them more efficiently.
Great. Yeah, makes sense. And then, okay, last question, and let's give one to Nivan on the M&A market in the North Sea. So, what has been the going rate for deals struck in the North Sea this year, and how do you expect that to evolve?
I mean, it's definitely been in and around that global average of around $60 to $65 per barrel. Perhaps even below that in some cases. Take, the Ineos Dong deal, for example. So a big change actually from what we saw in the past, where certainly good quality packages in the North Sea would tend to trade above that global average, particularly in Norway as well. So I'd say there's definitely been that window of opportunity for these smaller companies to actually get in the North Sea. In terms of where it goes moving forward, I mean, as I said, I think there's a lot of companies now targeting growth. A lot of divestment targets have been met, and so I think it will start to tighten over the next 12 to 18 months. But of course, oil price could change that completely.
Sure. All right, we are over the 30 minutes now, so I think that's all we've got time for today. There's a few other questions come in, which we will answer and include in the slide pack, which you will get access to. We'll send an email alert out later today with the link to the recording, to the slides, and the full Q&A. If there's any questions that come to mind after this, feel free to get in touch as well. We would welcome any feedback from attendees today. If this is something you would like to see more of from us, then that's the kind of thing we would love to hear from you about. Also, if there's any topics that you would like to get or to hear our opinion on, then that's the type of feedback as well that we would welcome. Finally, I'll just say that for a lot of our clients that have joined us today, we will no doubt see you shortly. We have trips planned to Aberdeen, Copenhagen, Stavanger and Oslo in the coming weeks and months, so hope to see you there. And finally, just a final, thank you for joining us and have a great day.